Thank you, Mr. Chairman. It's great to be talking about tax cuts. Since 2007, the temporary tax cut that was passed that year, that tax hike passed that year has transferred $6.3 billion additional dollars from Michigan families to Lansing. In just the last year alone, that tax hike deprived Michigan families of $771 million they had earned. It will take at least that much this year, and every year until it's rolled back or more. What did the state do with that extra $770 million last year? It's a big number, but it still might have been swallowed by the $1 billion in secret corporate welfare checks the state wrote to special interests under the mega tax subsidy deals approved in 2009, when revenue from that 2007 tax hike was just starting to roll in. More income tax dollars were transferred via corporate welfare handouts approved by Republicans. And now there's hearings on yet another $1.8 billion for a handful of big developers. Pundits, progressives, the League, Bernistas, and other voices on the left all express horror at the idea of a tax cut that lets families keep a little bit more of what they earn. Why then are they so quiet when it comes to transferring so much of what is taken to politically favored special interests? Isn't it the turn of regular, hardworking Michigan families and small businesses to get a better deal from Lansing too? The state can afford it. Despite tax cut fever rhetoric, Lansing has hardly been on a rigorous spending diet. Annual appropriations have increased from $25.2 billion in 2011 to $31 billion this year. Last May, the Revenue Estimating Conference projected general and school aid fund revenue of $22.5 billion this year. As of last month, the number for next year is up to $23.3 billion. That's a $764 billion increase. The question may not be whether Lansing can afford to give back, but who will it give back to? Who will you give back to? That 2007 tax hike damaged the state in other ways. It may have contributed to 49,000 former Michigan residents having left and taken their incomes permanently to some other state. Research done by the Mackinac Center has shown that for every 10% increase in personal taxes, an additional 4,900 people leave this state every year. And that's after controlling for other factors explaining why people move, like warmer weather and more hours of sunshine. Finally, Michigan's big business tax and labor reforms have made us more economically competitive, but we're lagging in vital tax burden metrics. The most recent tax foundation report shows Michigan at number 25 in state tax burdens. Last year, 31 other states celebrated their own tax freedom days before Michigan. Even Indiana and Ohio beat us. The economy won't expand forever, and no one wants to see another generation here watching their children have to leave the state for jobs. Michigan can't afford to not make itself more competitive on taxes, especially when we're competing against warm states like Florida and Texas that have no income tax. And I'll close very quickly with a quote from William McBride, who is the Tax Foundation's chief economist, who has surveyed the literature on the dynamic effects of tax cuts, as was asked about earlier. And what he said is, while there are a variety of methods and data sources, the results consistently point to significant negative effects of taxes on economic growth, even after controlling for various other factors, including spending, business cycle conditions, and monetary possible. So the Mackinac Center strongly supports this income tax cut. The more the better, the faster the better. Thank you.
Seeing no questions, Jack, we thank you for your testimony.
Thanks.